podcast. I'm Simon.
And I'm Simon.
I've been investing in property for over 20 years, and if you're an active landlord or planning your next property investment, this podcast is for you. Today I'm joined by Simon Glastonbury, who is an independent mortgage broker with 25 years of experience providing mortgages, bridging, and development finance for home buyers and investors. Of course, as Simon is joining us today, we are talking about mortgages and a little bit around them in the wider property market. But of course, any discussion at the moment on mortgages and inevitably the interest that they charge has to start with the recent Bank of England announcement. So Simon, what happened last week as we're recording and as this is going to go live actually, and how is that going to affect everyone?
Well, hi Simon again. It has Bank of England base rate has dropped 0.25% down to 4%, which is good. We're all celebrating. Was it expected? I think we look back on what we were saying. Yes, we were hopeful. We didn't quite know if it was going to happen or not.
I don't think they quite knew either. I had to go to a second vote. So very close.
Which is highly unusual, apparently. So that was good news. It's got to be good news. It's got to be good news in the property and the mortgage rate market. What does that mean going forward? That's what everybody wants to know. Has my mortgage rate been cut by 0.25%? Unless you're on a tracker rate, the simple answer is no. We need some sort of fanfare there, don't we?
These sound effects, yeah.
Yeah. Boo is the right one we have there. In short, they haven't. The mainstream lenders who usually lead the charge, as I say, on this, have started to drop rates, which is normal. Just for all our wonderful listeners, what will normally happen after Bank of England base rate cut, lenders will usually drop rates, fix rates, and what I'm talking about there, about a week or two after. I think they quite like to see what everybody else is doing, and then sort of drop. To give you an example, Santander, in their wisdom, dropped their rates pretty much immediately, but by 0.04%. Wonderful, makes absolutely no difference to anybody really. And then for the tracker rates, of course, we had the announcement on the 8th, and then someone like Barclays, I'm name dropping here, your tracker rate doesn't actually take effect until the 1st of September. So you're still paying a higher rate for virtually a month, which I think is a little bit naughty. I'm pretty sure they could catch up fairly quickly, because the base rate cut took effect immediately, but that's by the by. But I think I would like to think, and we would hope that rates will drop a little bit in the coming weeks. I think more it's sort of a nominal rate drop. It's a sort of feel good rate. If they do drop them, they've been built in for some time. That's why. And I think, again, people will say, and we're asked all the time, as soon as the rate drops, doesn't matter how many times you say to people, it's unlikely they're going to drop. As soon as you see the base rate cut, it's immediately, right, is my rate coming down? Unfortunately not. It's built in. The banks pretty much knew this was going to happen. If it wasn't going to happen in August, it would have happened in September, unless anything drastic changes. So it is good news. I mean, let's not disguise it. It is good news for the market. It's good news for mortgage rates. They are only going to come down. I'll go through it at the end, as we normally do, with our wonderful rate overview. The rates are back down. Residential rates have come back down below 4%, but they've been bubbling up and down, just over 4%, just coming back down below 4% again. Nothing too exciting, but it's got to be good news. It's got to put a boost into the market.
So, crystal ball gazing for just a moment, do you think we're likely to see much more movement on base rate as the rest of this year finishes out? I know there's some pressures from inflation and things which might be countering that. So I know what's your sort of intuition for what people are saying out there and things?
I think from looking at the markets and how what the markets are looking at for the rest of the year, there is an outside chance of another 0.25%. I would say outside. With inflation as it is at the moment, inflation reports which have just come out with the base rate cut, I would be surprised unless anything drastic happens with inflation over that time. But as we know, my predictions haven't been great this year. So, and I'm going by what the experts say, and people in the know an awful lot more than me, and I'm reading into what they're saying, and only following what the information given to me. And I really can't. I'm not sure. I don't think there will be one. If I was a betting man, I would say 4% is where we're going to be for a period of time now. And to be fair to myself, what I've been saying is for a long time, rates are pretty much bottomed out. What you're going to see now, I believe you're going to be, we're here for maybe the next year, 2 years. Yes, of course, you may get a time where someone wants to bring business into the marketplace. So they may, just want to bring business in, so they cut rates. So you may see a particular rate, like a residential rate down at maybe 3.5, 3.6, 3.7, just to bring some business in. And buy-to-let rates, similar-ish with some big fees again, as we've seen those before. So you may be really lucky to get something there. Don't expect rates to come down. I think that's to everybody. It's a note to everybody. I really do think we're kind of bottomed out at the market where we are, unless, again, I'll caveat that, unless anything happens with inflation.
Yeah. Predicting the future, always tricky, but yeah, thank you for giving that a go, and we'll see how things turn out later in the year.
Absolutely.
Thinking more about now, of course, we are in sort of the middle of summer, and I think traditionally in the property market and in a lot of sort of business generally, there's a lot of seasonality to everything and how customers behave and when they do things. And normally for the property market, the summer period is a quieter period, I think, from my sort of experience and from talking to people. And also as someone who sells a software product to people who are looking for property investment, I sort of see that seasonality in when people start subscribing and things. And I was expecting that again this year, but oddly, I saw a bump in new subscriptions in July, which is I thought a bit strange, but I think perhaps indicates that investors are starting to get ready and starting to think that this is the market or the stage of the property market that they are interested in. So, Simon, are you seeing a normal seasonality in your view of the property market? And how do you think the property market looks generally from that?
Seasonal is definitely it's a great question, and yes, we're like anybody else. When it comes to Christmas period, that's always very, very quiet, as you can imagine. Not many offers go in over Christmas, and the refinance side, after the first week in December, people are busy Christmas shopping. And we don't see very much until we step into the first, second week of the new year. I'd always wonder how Rightmove were always announced it years ago. It was either a very, very good marketing ploy, or it's true. Make up your own mind about Boxing Day being their busiest search day of the year. I just can't see that. It just looking on Rightmove on Boxing Day while watching James Bond is probably not the first thing I'm going to do. While you're still suffering from your roast dinner from the day before. I don't know. I mean, that may be a bit skeptical. It is an interesting one. If it is a marketing ploy, it's been brilliant because everybody knows about it. But it's definitely seasonal. It's definitely seasonal. We then pick up a little bit in the new year. I'm generally as a business, we're generally quite quiet in December. We then get very busy in January, and then again in the summer months. Not an awful. You can't really tell anything then from up until probably July time, because then people going on holiday, July and August. You definitely see a downturn in people buying property, July, August, and it definitely picks up again in September, going through it, because just naturally people are not around. You can tell that by the high street. You can tell that by your local shops and what have you. People are out and about. So yeah, looking on that, it'd be interesting. It's interesting what you say about you've had a pickup in July. We had a really, really busy July. Not so much in the purchase market. A lot of refinancing, a lot of people raising. Portfolio landlords definitely picking up a little bit more. They're raising a little bit more money, looking on the market, looking to see what's available. The market moving on from there, from what we're seeing, still very, very quiet. Still quiet on the investor side, buy to let, portfolio landlord. It's still whether that not the property on the market. I have a number who will buy if the properties come out. Certainly a number of portfolio landlords looking for good quality HMO prospects. They're looking those for the right property at the right price at the right time. You would generally find they like them in an area they're used to. Mm-hmm. So I will generally find if I have a client who has a portfolio of property, I think it's just natural. We will then look at the area where you're looking at. If you've got them in Birmingham, or if you've got them in Cardiff or Plymouth or wherever it may be, they like to stick to those areas. And unfortunately, the market then becomes very small, so it's quite difficult. But it's understandable, because you usually have the letting agent in that area. You usually have tradesmen in that area. So you're used to it, and I understand that. Trying to then move into a different area can be very, very tricky. So market quiet, I would say, for certainly on the investor side. But there isn't. I think the good news is there is an appetite. There is an appetite to buy. There is money there. The rates are good. The lenders want to lend money. So it kind of, with all of that mixed around in the pot, why is the market so slow? Why are there, if you talk to any agent worth their salt and been in the market for a long time and give you a truthful answer, they will all say, yeah, it's really slow. Very, very slow. Particular top end. Top end generally then comes out of the investor market and then goes into the residential side. You don't often see a landlord then buying a property for in excess of $500,000. Just doesn't make any sense. It's a huge asset to have on your books, huge stamp duty. Unless it's an HMO and they're doing something particular with it, you don't see it that often. So top end of the market is coming down, and we're seeing, if we're going back onto that, we're seeing huge hits on asking price at the top end. If it sat around for a while, 20-30% asking, off the list price isn't unusual. If the person really wants to sell, which is we haven't seen that for a long time. But then going back into the investor side, unfortunately for investors, the properties are not coming up. In HMOs, particularly multi-unit blocks, are being snapped up. They're really, really good. I have noticed a little bit more retail units, flats above, they're being snapped up quite quickly, because the rates have now come down where you can get them on a semi-commercial, reliant upon the income from the flat above, even if the shop's empty. The idea with all of these, generally, if you go quite high street, is to turn the retail unit into a residential premises at some point, because most councils will allow that to happen now. And the rental is generally, I'm generalizing here, of course, generally more secure on a residential property, because retail units in a small high street, let's just call it, they're affected so much by how the market, what's going on. It's very difficult. Shops coming in and out. It's, the rental can be tricky, to say the least. So people are going into there. Landlords are going in there again. Right. Well, I've got the rental from the flat above, and usually above commercial premises, the flats above are usually really, really good sizes. So that's why I think they're being snapped up really quickly, because they can rent those, turn the bottom into a residential at some point, fairly easy. Don't usually lose a huge amount of rental, refinance away when they've done it. So they're quite good, that side of the market. But again, it's about picking up the property when it's picked up. Lenders generally like you to have some sort of experience in that as well, which can be a little tricky. Otherwise, the deposits are quick. Then going on, first-time buyers. Very, very few first-time buyers in the market.
Yeah. We're going to mention, actually, our next sort of topic on our list is the recent announcements from the government to try and improve first-time buyers in the market. And I take it from what you just said and what we mentioned briefly before the call, that you're not seeing that materialize, at least yet. But then again, it sounds like that could also be being affected by the seasonality as well.
Yeah, definitely. I think so. I think we've surely got a lot of first-time or potential first-time buyers built up, waiting, just looking. We want to buy. It's about the right time. Well, you would think now, I can only think it's because there are not enough properties on the market, not enough choice. So people are saying, no, I don't want to buy yet, because rates are very good historically. The 1%, 1.25% rates they're in the distance now. They're behind us. We're not really looking at those anymore. We like to, but we know we're not.
Yeah.
So they're in the past. Pretty much everybody realizes if you're a first-time buyer, you're going to be paying 4.5%. Historically, that's still a very good rate. So that's very good. People seem to have deposits available, be it from savings or bank of mum and dad, wherever it may be. It's surely just about the property. I just don't think there's enough choice on the market at this moment. But that then goes on. There's a domino effect there. There has to be property set for second-time buyers, third-time buyers, 2-bedroom, 3-bedroom, 4-bedroom properties on the market for them to move. Otherwise, they're not moving out of the 1-bedroom flats to let new first-time buyers in. But going back to the government announcement and initiative we were talking about earlier, anything like this is welcomed. Absolutely anything, because they clearly know there is an issue with first-time buyers in the marketplace.
Well,
Otherwise,
I think they've been listening to you. I know on many past episodes you've said we need the first-time buyers, that we need them coming into the market. So they've clearly been listening.
Absolutely, someone is listening to me finally, which is great. I like these things. Now the problem is, as the lenders have to take this initiative up. It's good saying, "Oh, yeah, we will," for the government to say, "Yeah, we'll have an initiative to try and push these first-time buyers through." The lenders have to then create a product that suits. Now, they're not going to do this off their own back. They've got no doubt. I'm guessing here, but it makes common sense that they're talking to each other and saying, "Well, what should we do about this? Shall we come out with a product that meets all of this? And what's in it for us? We're a bank. We need to make money. Is it going to be a good product for us?" Now, what we do know is it's going to be higher risk, because if they're lending more money at greater income multiples with a smaller deposit to first-time buyers who've never experienced this before, what's on the horizon? If they've only got a 5% deposit, they're lending, let's call it 6 times income. That's the riskiest lending on their book at this time. Are we then going back to the days of the early 2000s where we're getting up close to 100% mortgages again. It doesn't take, if you're buying something which is slightly overpriced, and that's not difficult. 5% on a purchase price. I mean, at the end of the day, an estate agent has come around and gone, yeah, I think it's worth that.
Yeah, yeah.
They're putting a 5% down, and actually they're just getting back to net zero. So that only has to drop a bit. We could have a market realignment. All of a sudden you have all of these people who are in negative equity as such. They're going, what am I going to do? It could be years. The market's stagnant, rate stagnant. They're going to come back down again. So from a lender point of view, I can see why they're not as keen. They haven't. This announcement came out. We talked about it off air slightly, and it was announced and disappeared. Nothing. We were digging around to try and find it. None of the lenders have come out and with a big fanfare and say, "Oh, we've got this great product. The government are behind us. Let's go. First time buyers everywhere." It just hasn't happened. Now, it does, like I say, I'll go back. To be fair to them, they have to create the products. They have to put it has to fit their systems, their criteria. A lot of this is sort of AI based now, lending. Their computer systems, their software systems have to take it all on board. That all has to change. So it may be, and of course, when we go back, and it's a good point you made about seasonal. Why launch it now? July, August, when it's notoriously quiet. If you're going to do something that radical, you would launch it in September, maybe October, when we've got some momentum again. We know again that the estate agents are very quiet when it's sunny. It's hot. You speak to anybody when people don't want to go looking at houses when it's 30 odd degrees outside. And we have, which is nice, we've had a really good summer. So that it will definitely have an effect when you see these things, and you go, oh, well, I'll put that off and, let's enjoy the sunshine at the moment. I mean, there could be the other side of the argument going, we really need a garden. So let's go and look. But I think it will be the first one.
Yeah.
So yeah, I mean, let's celebrate this and saying we've got to, if the government come out with these ideas, great. But it tells us that there is a problem with first-time buyers and they need to do something. And they need to do something quick to boost that market all the way along.
Yeah, yeah. It sounds like we're sort of got a lot of foundations coming together ready for the post-summer market, really. We've got lots of people away and thinking about other things in summer, but clearly we've got some investors starting to see that the market is a buyer's market and that there's potential there. And you said there's lots of sellers who are accepting big discounts on asking prices because they appreciate that it's a buyer's market, and if they want to sell, that's what they have to do. And then we've got first-time buyers perhaps starting to come back into the mix if the lenders actually get themselves sorted out and get some products launched, perhaps just after summer again. So maybe the foundations and the momentum is building there, that come September, October, we will actually have a really busy property market again. Do you think there's enough momentum getting ready for that? Or do you think it's actually just going to be sort of picking up to a more normal level rather than a sort of excited level?
I think that's a really, really good summary there. And yes, I mean, if you put all that in the melting pot, the signs are all there for the market to pick up and pick up to be, yes, at least back to normal, as it were, but to have a really strong end of year. And that will then take us into 2026. Yeah, I think we've got, there's everything there for a really, really good market. Everything's pointing that direction. And what we do know as a society is we don't like waiting too long. If we've got it in our head that we want to move, There's only a certain amount of time before we're going, right, we're pressing the button. We are going to move. I'm waiting for that extra bedroom. I want that bigger kitchen. I want whatever it may be. So, yeah, I think so. I think the market is there. It's waiting for it to happen. Everything is in the right place. And then all we need now is for everybody to come back off a holiday. And we're in, and we're in some really good times. There's nothing in the or looking on the horizon for any sort of correction in house prices. That all of that talk has been, there was just a little chatter here and there. It's happened every now and then. We've not seen it, but yeah. Although I say, yeah, I've seen some big reduction in asking prices, but of course, your property is only worth what you're actually going to sell it. If you've got £1 million property and you were told once that it was worth 1.5, well, you've never actually sold it for 1.5, so it's not worth 1.5. So it's only worth what someone's going to pay for it in the current market. Now, it might be worth 1.5 in 10 years, but we're here as we are now. So, there are corrections, and again, you don't have to sell at the reduced price if you don't want to. So again, everything is pointing in the right direction. I think anything which has been sitting on the market for a long time is clearly overpriced. So therefore, what you need to do is if you want to sell, you reduce or you take it off the market and wait for the market to pick up again. When the market does pick up again, unfortunately, we get into that time silly bidding wars again. But that's just how it is, isn't it? We can't do much about that. But certainly, we are seeing things. I have seen clients who have got larger properties, larger values on the market. What we are seeing is footfall. People are going now. They're not having offers on their property, unfortunately, because they're in a chain. And people are keen, but they're in a chain. So let's hope the summer months go past. We're now mid-August. It's not long, as we know, all of a sudden, holidays are over, kids are back to school, right, let's move. That's also an interesting one. We're talking seasonal. It's about we can't move until the children are in the school, so then what? And it just, every little thing like that boosts and moves it on and moves, so that's got to be good. I think your summary was perfect, and I think everything is ready for a really, really good autumn. Watch this space.
Fantastic. So with that amazing bit of positivity, let's head straight into our mortgage market rate roundup, if I can say it. Right.
Absolutely.
So we normally start with the sort of simple end of the market, which is just standard sort of residential mortgages. So not investors at this point, just normal residential. So where are we looking there, Simon?
Well, we've got at the lowest rate we can get on the market, 2-year remortgage at 75%. We're down at 3.95, 3.96 for a 5-year. Interesting thing at the moment is that 2-year rates for the first time have come now below 5-year rates. Historically, that never happened. 2-year rates were always lower than 5. But it's taken since the rate adjustments and the increases in base rates, it's taken that, which is a number of years now. It's taken up that until now for that adjustment to go back to where we would expect it. So 2-year rates now are slightly lower than 5-year rates. What that tells us, we don't really know. What you still got to look at your own situation. But 2-year and 5-year rates being below 4%, that's great money. Historically, that's really, really good money. I think when it goes down now, something else to throw in the melting pot, it's really, really good for the market going forward. For a mover, you can get a 3.86 2-year rate. If you haven't quite got that sort of deposit, you're up at 90%. So you're still looking at a 2-year rate of 4.18, 5-year at 4.19. Now that's with a 10% deposit. I think that's brilliant. I think that's really, really good money. The difference between the two is minimal, really. And that's really good. Even up at 95%, so you're generally for first-time buyers, 2-year rate 4.7. I think that's really, really good. That not quite so attractive. So if you can get that extra 5%, it's definitely worth it. I tell any first time buyers, you are going to get the better rates starting with a 10% deposit and then drop down, but it doesn't actually make that much difference between 90 and a 75% mortgage. So that's quite interesting in itself. Clearly, if you can get the bigger deposit, the better. Now, going on to wonderful word of buy-to-lets and our investors. I've looked at remortgage rates for our buy-to-lets in personal name. I've changed that over. I usually look at purchase because we're just not seeing any purchases in personal names now.
Yep. Good point.
And we know why. With the tax changes, we don't need to go over that again. But of course, if they're already in personal name, you're not going to move them out. I've done literally a handful of changing them over, and that is because they're fairly new, and it kind of works out, and very low value because of stamp duty issue. It just doesn't make any sense. But there are some silly rates out there. It's still silly season. 2.49 with a 7% fee.
Oh, damn.
2-year fixed rate. But if I just looked at the best rates, 4.29%, 2-year fixed rate, 0 fee. That's good going, I think, in a personal name. Or a 5-year rate, 4.07 with a £2,000 fee added to the mortgage.
Yeah, not bad at all, actually.
Pretty good, isn't it? I thought you'd be impressed with that. I know. I'd like to cheer you up, Simon.
I think
that's
they're good rates,
Now, if we go on to where we're the busiest, the buyer, if you're in the buying market for a limited company, you're going to be putting it in a limited company name. If you're not, I'd want to, as an advisor, I'd seriously want to know why, and have a word with your accountant. But let's look at those buying rates. Again, silly season. 2-year, I'll tell you the 2-year, you're not really going to be looking at a 2-year. We know this stress testing on a limited company buy-to-let is much better on a 5. Everybody, I put my neck on the line, pretty much goes for a 5-year rate. So let's look at 5-year rates. 3.72 with a 6% fee. But,
ouch.
Yeah, 5.06 with 0 fee. That's pretty good.
Yeah,
if it's 5% buy-to-let, it's about 1% higher than a residential.
Yeah.
But without a fee, but I think most landlords would live with that. I think if you look at the figures, and there are plenty in between, it does work out. I'll caveat that again, as we always do. It does depend on the loan size, the property value. Certainly speak to the broker and we can work it out. But I like that one. I thought that was really good. HMO, much the same. HMOs are all going into limited company names again, as you would expect. Lowest one I can get, 4.2 with a 6% fee. Really, mate? Is that going to work? I'm not sure. But 5.14 with a £2,000 fee. Again, HMO, limited company, £2,000 fee on a 5-year fixed. I think that's good.
I mean, that's remarkably close to just the buy-to-let still. I mean, they have been for quite a while very close, and that is still very close.
Yeah, absolutely. It's nice to see, I think, gone are the days where we were speaking a few years ago where the HMO rates were 1.5% above. And you were all going, well, it's an HMO. We've got to kind of take it on the chin. This is what it is. Silently in the background, lenders have brought those rates right down and been really competitive. So it sort of does make you believe that they do want the business. They're out there trying to get the business. It's not that far off residential rates. Back in the day, you're talking 10 years, 15 years ago, the buy-to-let rates were 1.5-2% difference. They really were. Now they're a lot closer. I know the rates are lower, or can be, or slightly, but they're out there lending money. And if it's in a reminder, if it's a limited company name, the stress testing 9 out of 10 times is much better. So you will get those. So it isn't unusual unless you're in London, a London borough. They're quite the stress testing doesn't work so much because the property price is so high. And the rent doesn't quite, although the rent is better, it doesn't quite meet where it needs to be. but pretty much that's the only place I've really found it being an issue. Anywhere else, because we did go through a period of stress testing being quite awkward when it was in
Yeah.
personal names.
Yeah.
Now it just isn't becoming so much of an issue. Certainly with HMO anyway, because the rental's so much better. So, but certainly if you're looking at limited company buy-to-lets, stress testing is much better these days, and there's always something around it. So I think there's positive. I mean, overall, it's a positive day. Lenders looking, the market is ready. I think it's definitely ready to go, and the rates are good. May I say?
Yes, I think I agree. I think, yeah. Let's just finish there while everything's positive.
Absolutely.
So the market is primed to pounce, I think. And
absolutely.
if you as a listener are needing to get your mortgages sorted out to join in with this autumn excitement in the market, then please do get in touch with Simon Glastonbury. His contact details are in the show notes. And yes, what a fantastic, positive episode and outlook into the rest of the year. So thank you very much, Simon.
Pleasure.
And for everyone listening, I will talk to you again next time.